First rates any second now will just come up on your screen. I'll refer to the screen to read the first rates, and the first rates are, it's a flat start with a positive bias. The market breadth I think is looking better and much better than what it has looked in a long time. You got, let's address first ICICI Bank and ICICI Securities. That is the big news maker. ICICI Securities in the pre-open session when we checked, it was locked up 20%, but it has opened with a gap up start of 11%. ICICI Bank, if they're looking at a share swap, that's what we understand, completely source-based information, it may not really move the needle incrementally for them in a very substantial manner. The breadth I think is looking very powerful, and that I think is the standout feature at least in this market. You want to look at some pharma names, Divi's, Laurus, Cipla, Natco. Divi's up 21 rupees, Laurus flat, Natco, Cipla is also off to a flat start, and Natco is at 687 rupees. I want to look at power stocks now, and when there is a downpour which has started, the power demand actually normally changes. NTPC, Tata Power, JSW Energy and Power Grid. So you don't have any high flyers in the morning session per se, but incrementally here and there, I guess the market is off to a constructive start.
Yeah, not high flyer, but ICICI Securities, as you pointed out, is sitting at 52-week high levels. However, on the losing side, do pull up Shree Cement. That stock is down by almost 8 to 10%. So that entire IT search is having a bit of a negative impact. Labs as well in focus because there was some observations made by US FDA, so we are watching out for that. You also have SBI Cards, which has started on the back foot. There was a downgrade that came in from Nomura. Quite opposite for Tata Consumer. Citi had initiated coverage with a target price which was over 1,000 rupees. As far as Tata Consumer goes, if I have it right, yes. So that stock is high by almost 2%. In fact, sectorally speaking, most of the sectors have opened in the green. ICICI Bank is your top gainer in terms of the banking names, and except IT and maybe energy space, most of the stocks and sectors are trading in the green amount.
Yes, indeed. Some of the other stocks that continue to remain in the spotlight include heavyweights like Adani Enterprises, TCS, Power Grid. They're all losing a bit of steam this morning. But let's get in a take from our chartists. What's the first trade that they're punching in? How are they looking at that healthy market breadth? And the levels on the index at 18,681. Kunal, what's the screen indicating in expiry week?
Well, I would believe that it could probably be the next couple of days could be more of adjusting the positions for the next series. So I think what's going to be important is to see the extent of rollovers for the index as well as for the individual stocks, and especially the stocks which have been seeing a lot of rally for themselves. So we need to see whether the bulls are ready to carry forward the position. So that can probably be seen in terms of the data. The stock which I would look to trade in the open would be Tata Motors. I think the stock has come back towards the 22 moving average at 557, 558 levels and looks as an attractive contra bet for a buy at current levels.
What are the first trades you are spotting, Nuresh?
Being defensive, looking at NTPC at 185, 186, much closer to an all-time high. This could be a stock which would slowly and steadily break out over the next few sessions.
Well, Gautam Trivedi joins us. Let's take our conversation forward. Let's understand what he makes of the current markets as a setup. Gautam, good to have you back. Thank you for joining us. We've had a good summer rally. 2023 has been, the summer rally of 2023 has been one of the most powerful rallies we've seen in a long time. Do you think we are done with the rally, or this rally has still some more legs left?
Yeah, I think to put things in perspective, it's important to understand that this is a global rally. It's not just a Asia or India rally, as much as a lot of people here seem to believe. We are only the fourth highest recipient of FPI flows in Asia year to date. So if you look at China northbound flows, we've seen about $28 billion. Korea's seen $13.3 billion of FPI flows, and Taiwan's $9 billion. So we are actually at 7.6, number 4 on the Asia Pacific list of FPI flows. That's one. The second thing to bear in mind is that the rally, when I say it's global, you've seen the German DAX, which is up 16%. That's a new lifetime high. The French CAC is near a lifetime high. The Nikkei is at a lifetime high. So I think this rally is a global phenomenon, not limited only to Asia. And I think this seems to have some more legs as of now. Now, specific to your question about India, my concern is, and I'm sometimes in the minority here, but my concern is that the valuation premium that we've got now is quite high. So we are now at MSCI India, calendar 24 is at 20 times. So that's CY24 PE. That's at a 60% premium to MSCI Asia ex Japan, where the median for the last 10 years has been 31% in terms of premium to MSCI Asia ex Japan. So I think these are issues at the MSCI basket, but I think the rally in the mid caps has still legs and will continue. And also, of course, a positive fallout of Prime Minister Modi's visit to the US.
What to your mind could be the red light? Could it be valuation? Could it be supply? Could it be pure reversal in global markets? When would you say that, look, it's time to take some chips off the table now?
Yeah, I think that's a fair question, Nikunj. I think I just got back from the US. The one thing that I clearly did not see is any signs of a US slowdown or recession. So if the recession may happen later this year or early next year, so that's obviously clearly a threat. The probability by economists is still at as high as 65% of a US recession likely to happen. So that's one. I think the other issues that I see would be state elections. You know, we've got some major state elections coming up. If for whatever reason the BJP doesn't fare or the NDA doesn't fare as well as market expectations, that could potentially be a bit of a dampener. And I guess the El Nino effect on the monsoon, and you know, honestly, you and I both are not experts on this, but if that were to mess things up as far as agriculture is concerned, it does impact a whole swath of industries and businesses that are dependent on rural income. So yeah, I think these are the three things that I personally think could end up dampening the rally.
What about pure demand supply dynamics? IPOs have started, QIPs will start soon, then big IPOs will start, then big OFS will start, then anchor supply will start. I mean, it's a cycle, isn't it? If macros are okay, valuations are not that stretched, if liquidity is benign, then suddenly promoters will start to come out, anchor investors will come out. Isn't that a real risk?
You mean the risk of supply of paper? I don't know if that's necessarily at risk. It might, you know, it's part of the evolution of the Indian equity markets and the ability of Indian companies to keep raising capital. And the market cap of our country, as you know, consistently has grown at 11%, 11 to 12% over the last decade in dollar terms. So I don't see that really being an issue. In fact, if you look at what's happened over the last about 10 days or so, bulk of the sell downs that we saw in terms of blocks of Indian companies got lapped up by a whole bunch of foreign institutional investors. Interestingly, most of these blocks got done in the block window, i.e. At a maximum discount of 1%. So that's the kind of demand that's out there for a lot of these mid-cap companies whose blocks got crossed over the last 10 days. So I don't see that really being an issue in terms of supply.
Okay. You bought a lot into the niche consumption space, Indian hotels, landmarks. Some of these stocks have done very well for your clients and for you. Good call. But would you like to stay invested in this entire niche consumption theme for next couple of years?
You know, we don't own Indian hotels. That's the one we missed, and we feel pretty bad about it. But landmark cards, I think, is a good example of being a classic urban play. We also own Sapphire Foods as another urban play. And I tell our investors that we really are seeing signs of two Indias. One, of course, being urban India, the other being the tier 3, tier 4, and the rest of India. And the fact is that you're still not seeing any significant slowdown in urban India. If you look at air traffic, if you look at the hotel industry, if you look at premium and luxury car sales. So that continues at a very strong pace. There might be a bit of a slowdown, but I still don't see any significant slowdown happening. So we're playing that through the urban consumption themes like a Landmark or a Sapphire Foods.
Landmark and Sapphire, these are the top consumption plays that you have. But I was also looking at the names of some of the financials that you hold. And please do correct me if I'm wrong, but I do see Axis Bank, HDFC Bank there, and IDFC First Bank. Your view specifically on IDFC First Bank, because now the street is getting worried that perhaps the prices have moved ahead of the fundamentals, and they're talking about select profit booking there.
So I think on IDFC First Bank, we own IDFC Limited, and we bought it as a sum of the parts play, given the fact that it was trading at a massive discount to IDFC, on a sum of the parts trading at a massive discount to IDFC First, of which it owns 40%. So point being that I think that trade actually has played out very well for us. And once the merger is consummated and we end up getting shares of IDFC First Bank, we'll take a call on what to do, whether we book profits or we continue holding shares of IDFC First Bank.
Okay, so that's about the financial space, but I'm intrigued to know what's your view as far as IT goes. You did hint about it in your first answer, but are you looking at it constructively now? Do you think the worst is priced in?
You know, here's the thing. It's a very good question. I don't have a good answer, unfortunately, because there's a lot of chatter about AI potentially in 2 to 3 years being able to replicate some of the stuff the Indian IT companies do. How will that evolve? How will that play out? How will investors price that in today or maybe in 6 months? I really don't have an answer to that. I think let's just wait for results of the IT companies, which will be out in the next 3 weeks. We'll get a better sense. But I think the one that we do own, which is Infosys, has been the worst hit of the IT pack. And, given valuations today where it is, maybe it's worth buying some. I don't know the answer, frankly. We're a little lost on the IT space.
What are you doing with your Infosys holdings? Sitting tight?
I'm sorry, can you repeat that?
What are you doing with your holdings in Infosys? Sitting tight?
We're sitting tight. It's a great company otherwise. Just that we timed it wrong. We bought it at the time when foreigners were selling IT, but the problem is the selling continued. We thought it had bottomed out. So if I look at this particular quarter, and we've got a week left, this week left for the quarter to end, but this quarter alone, foreign institutional investors have sold about $1.9 billion of Indian IT companies. So the selling still continues, unfortunately, and we're really confused on what to do with it.
Hi, Gautam. Morning. Wanted to also understand what the outlook is when it comes to the entire defense and railway space as a whole. Has there been anything that's caught your eye or anything that you all are looking to add to the portfolio?
Good question. And another area that we've actually sort of missed out on, we didn't see the rapid pace at which the indigenization would actually happen, because we'd heard this multiple times in the past with the previous governments. Never really happened. And now it's actually happening. So some of these stocks have run up a fair bit. A lot of them happen to be PSUs, and they have a bit of a monopolistic advantage, if you will. But the point is, will there be new companies emerging? There's, I believe, a drone company. We haven't looked at it, but I believe there's a drone company IPOing this week. So I think there'll be more opportunities coming through. And while we've missed out on the first move, we're certainly looking at that space for sure.
Gautam, we've seen record inflows into India.
Yeah.
Yet the haloed stocks like a Reliance, HDFC Bank, Infosys, large corporate banks, which are like the real go-to stocks when ETF allocation comes back to a country, are underperforming. Why is this time the money which is coming back to India by global investors is not going into the traditional names and traditional stocks?
I think that's a fair observation. And, who would have thought finally an ITC or a Mahindra or a Tata Motors would actually start performing, right? Frankly, in the past, when I've got calls from the sell side saying you should look at these stocks, I'm past as in the last 2 years, and I've unfortunately got those. But money should be coming back into the blue chip companies like a Reliance Industries or an HDFC Bank. I think it's a matter of time. But if you look at the amount of money that's come in this quarter again, BFSI stocks have taken in the bulk of it, about $3.5 billion of FPI flows. So I think it's a matter of time before that money comes back. Specific to Reliance, I think there's a lot of value unlocking that's still to happen, whether it is Geo Financial Services or Geo Platforms itself, whenever that ends up having a mega IPO. So I think that stock is clearly undervalued. It's been one of my favorite long-only plays in this market.
One big assumption, I think it's an easy assumption, is that interest rates have peaked out, at least locally.
Yeah.
If interest rates have peaked out, what could be the implications of that? Do you think growth stocks will come back? Do you think NBFCs will come back? Because that's like the biggest moving part in last 24 months for everybody.
Yeah, I think if you look at today's your own very own newspaper, the Economic Times, talks about credit card debt being at a record high of some 2 lakh crores. So I think if interest rates indeed have peaked out, and I hope they have, it's going to benefit the whole country. I mean, across the board, not just retail lending, but even corporate lending, because I'm sure a lot of corporates have put off taking on new projects and putting on capex until they have clarity on interest rates. So I think it's gonna be positive for the whole country across the board, including CV sales. I mean, NBFCs, I think will do well for sure.
All right, Gautam, really appreciate your time. So glad you could join us. Really wonderful to have you on the show. Markets, meanwhile, what do we have? We've got, no large, powerful trend per se. You've got Cipla, which is up, Aurobindo Pharma, if you realize it, but sub 400 has become 700 in this year itself. We've got constructive price action, HAL, even though it is part of FNO ban. ICICI Bank, well, ICICI is the one which is moving, largely because if the share swap goes through source-based information, there would be disproportionate advantage. But no fireworks, honestly. I mean, the Sensex is flat, Nifty is flat, nothing in the large, meaningful, in the mid-cap space, which could be called as a very meaningful, mover per se. Let's connect with the management of Fortis. Dr. Ashutosh Raghuvanshi, Managing Director and CEO of Fortis Healthcare, joins us now. Fortis clearly is in the middle of restructuring because a few days ago they acquired an asset. Now they're looking at divesting assets. So they're really cleaning up what could be called as the excesses and adding up capacity where scale and benefits could kick in. So Dr. Raghuvanshi, looks like this is in line with what you'd indicated. Get rid of excess fat and add muscle. You added capacity and you are selling assets which are not making money. Walk us through that. Why are you looking at divesting a 110 bed capacity of the Arcot unit?
Good morning, Nikunj. Thanks for having me. This facility wasn't performing up to our expectations, and then also, as we have said repeatedly, that the ongoing divestment is just part of the portfolio rationalization strategy. We want to deepen our presence in the clusters where we are strong and we have a sizable presence. At the same time, we do not want to persist with projects which are not performing too well. So it is essentially in line with what we have been saying, and that's why we are enhancing capacity in the NCR cluster and many other clusters. But we decided that this was the right time for us to move, and somebody else could do better with this asset.
So is this again a clear endorsement of what you said, that you would not have a significant presence outside the NCR region and maybe certain western parts of India, but you will not be present in east and south because this facility is in Chennai?
Yes, so it is specific to Chennai cluster because we had only 2 units there and both were performing suboptimally. However, Bangalore remains a focused cluster. We already have 5 units over there. We would look to deepen our presence there further. Calcutta and Punjab are 2 other clusters other than the 2 you mentioned, Western India and the NCR cluster itself.
Any other such loss-making facilities or units which you've identified which sooner than later you could be exiting out of?
So we continuously keep on reviewing our portfolio. There are certain units, as I said, which have not been performing too well. The second unit in Chennai has also not been performing well. So we will evaluate the right options at the right time.
But sir, how many plans are going to be there in FY24 and FY25? Because what it would actually do is that it will change. It will, if you are able to exit some of these loss-making units, your aggregate picture will change completely.
Yeah, so these 2 units essentially are the ones which we are immediately looking at. The others, we have a couple of other units which have been performing subpar, 3 more units to be precise. And those units, we are doing operational changes. We are adding new service lines, etc. And we are pretty hopeful that those would be turned around over the next 1.5 years or so. So I think this is where we would stop, and we would rather focus now on brownfield expansion and then opportunistically looking for further acquisitions as well.
So how many beds you will have by end of 24 because of acquisition and because of divestment? What would be that number for FY24?
we would be around 4,800 beds, and which will go to 5,400 by 25.
Munshi, we had the management of NH Healthcare, Mr. Shetty, on the channel a few days ago. We also had some of your other peers from Apollo Hospital on the channel. All of them are now looking at creating massive capacity. And the industry is looking at creating a massive capacity at a time when the total occupancy rate is anywhere between 55 to 65%. So don't you fear that 2 years, 3 years down the line, there would be massive capacity addition which will take place, because also hospitals are expanding at a time when the capacity is not even closer to 80%. It's at 55 to 65%, everybody is expanding.
Yes, so 75%, Nikunj, is an ideal capacity occupancy level of a hospital. Beyond that, the operations become inefficient, and it causes inconvenience to the patients coming in and going out of the hospital. So that is the optimal level at which all hospitals want to reach. Currently, there is a lot of shortage in many, many markets of beds. And with the increasing penetration of insurance, which has been adding quite fast in the, especially post-pandemic, we expect that the capacity utilization will become better. Other than that, what is also happening parallelly is that the rationalization of some of the scheme prices have started happening. We have recently seen upward revision in some of the CGHS rates, and we have been told that the rest of the rates of CGHS are also being revised. So with that, I think that will also become an attractive segment for hospitals to serve. And that is where the capacity utilization will happen.
Okay. Morning, I wanted to also understand the update on the transaction for the Meteor Hospital in terms of how margin accretive that is expected to be and what the overall timeline is. Has it now been completed?
So we expect to conclude that transaction also by end of July. And similarly, we expect to close the Arcot Road also by end of July. Manesar facility will, in Meteor facility, will require refurbishment. It will take us about 8 to 9 months to get it operational. Once it is operational, we will initially operationalize 200 beds. And we expect this market, since we are present here and we understand this market well, and it will also be synergistic to our other facilities. So in Gurgaon micro market, this should mature much faster than a traditional greenfield hospital. But for all practical purposes, this hospital should be looked as a greenfield hospital. So we expect it to take about a year or so after operationalizing to turn cash positive.
Dr. Raghuvanshi, everybody is waiting, and the wait continues on the next update on the legal front.
Yes, so legally, we strongly believe, and that is the legal advice we have received from some of the great luminaries in legal field, that there is no overhang of the Supreme Court case which was there. There is no embargo on any further corporate actions. So we are planning what corporate actions need to be taken, and we have started initiating those. It is an early stage of planning, so I cannot really comment on what specific actions we are going to take, but we are at a threshold of starting those some of those actions.
Vanshi, are you hinting at the SRL IPO? Is that the corporate action?
SRL has had performed subpar compared to the competitors in past few years. Currently, we are focusing on improving the operational efficiency of the company. Any other actions would be taken at the right time. As of now, we haven't taken any concrete steps in that direction. But as and when we do decide, the board takes those decisions, we will certainly be informing you.
My final question, Dr. Raghuvanshi, is that this is a feeler which I get when I speak to investors, funds which own your stock and brokerages which track your stock, which is that the legal case is an overhang and it is not business as usual for Fortis. Is that true, sir? that if the open offer goes through, then only it will be business as usual. Right now, there is a bit of a deterrent here. Fortis is doing all the hard work, but guess what? Their one leg and hand is tied.
There is definitely a perception problem here, and we need to overcome that. There is no denying of that. There is a confusion sometimes as to what the Supreme Court judgment actually meant. But for all practical purposes, I don't think we are constrained, and you would see a good growth coming in the future.
So you're running with you're running with on two legs, and if the open offer would have hypothetically gone through also, this really would have been the normal business progress. So it is business as usual for Fortis, right?
Yeah, we're running with two legs, but certainly there are some headwinds.
Okay, appreciate your time, sir. You've always been very honest and really thankful for your time.
Thank you so much.
What do we have on the markets? We've got a nice little juicy recovery in the markets, and the stock is reacting. There you go, 89 back. They are running, and they are running in the right direction. Just look at Fortis and look at Narayana Hyderabad, look at Shalby, look at Kames, a lot of hospital stocks, look at Global Healthcare, which is Medanta, and just look at the 52-week change here. Fortis, because of this entire legal issue, in last 1 year has done precious little. 52-week change for Fortis. I mean, this we are looking at the open offer when this is the whole legal issue had come through. But if you in general look at Fortis, it has done nothing. I mean, we are comparing the stock from the open offer low when the Supreme Court verdict was not in their favor. But if you look at NH, Apollo, hospitals as a category have really created a lot of wealth. And if this overhang would have not been there, the stock of Fortis would have been a completely different kettle of fish. That's my limited point.
Okay, let's see what happens to this stock. Definitely now there are triggers available, as in when this headwind gets sorted, we might see that run up happening and catch up happening with the rest of the space. Just wanted to highlight a few stocks as well. Tata Consumers is higher by around 2.6%, as we pointed out earlier. There's a brokerage initiation that happened. Citi with a target price of over 1,000 rupees. So that stock is your top gainer at the index level. TCS is on the back foot. You have Tata Steel, HDFC, some of the other losers as well. But I think we can welcome on board the next management on the show. We have with us Mr. Ved P. Goel, the Group Chief Financial Officer, Dr. Lal Patlab, joining us on the show. Hi, Ved. Thank you so much for making time and speaking with us. Well, in the latest development, the government has revised the rates of 36 radiology imaging investigation, and the other CGHS rates, etc., have also been increased. Does it impact your business a lot? Could you talk to us about if yes, what would be the impact? You'll have to unmute yourself, Ved. I think we can't hear you properly.
Sorry. Hi, good morning. So these increase on these CGHS rates are increased for radiology, not pathology right now. So we don't have much radiology in our system, so there is not much impact on our business due to this increase.
Increase in pathology as well? If yes, what's the timeline of that revision?
As of now, we don't have any idea, but yes, there is a conversation going on. They are supposed to increase rates for pathology as well, but as of now, there is no news.
What are the rates which are capped in the entire pathology business? Because our understanding is that right now for test, it was only during COVID when there was a price cap, but right now firms and companies which are offering this service, they're free to charge whatever they want.
Yeah, you are right, Nikunja. So there is no capping as such, but during pandemic or during special occasions, whenever governments step in, they cap prices. Like we have seen in COVID, they have capped the prices for COVID RT-PCR test. But right now, there is no capping as such.
I want to also understand that what's happening in the entire pathology business. There was the sugar rush which happened during COVID. Everybody had to test. And it was not the COVID RT-PCR test, it was the accompanying test of a D-dimer or perhaps a CRP, which in a sense was really helping the industry get an extraordinary profit bulge. Do you think large part of that COVID sugar rush is over and now it is back to the pre-COVID business growth for the pathology business?
Oh yes, I mean, this COVID is no more. In fact, for last couple of quarters, if you see our contribution for COVID business is about 2%, 2.5% for the full year. last FY22. So I don't think now there is COVID business which is happening. Whatever is happening is largely for the travel or some basic surgery kind of requirement. But having said that, we since beginning was focused on non-COVID business. We have narrated that this is not sustainable. This is not stay here, and that's where our non-COVID growth is very as per pre-COVID levels. We have already achieved whatever pre-COVID level we were doing. So we are back on track in terms of non-COVID. And anyway, we are not factoring any COVID business for the future. As far as industry, I think the whole industry is, in my view, is doing whatever pre-COVID levels. And I think after this COVID or during COVID, the expansion in terms of spending on, especially on healthcare, including diagnostic, has gone up. So industry size, industry opportunities definitely has gone up. Within that, specifically, if I talk about diagnostic, is more beneficiary because now the more and more tests are happening or people are more conscious about health. So I think overall industry is growing or should grow faster than what pre-COVID level.
Ved, would you help us understand the trend in terms of what's the volume of patients been like over the last couple of months, and what's the revenue per patient? Have you taken any price hikes recently?
Yes, so revenue per patient has gone slightly up because of two reasons. One is mix change because we have SwasthFit, which has contributed highest. I think it is now more than 20% of our business, which has higher realization per patient as compared to normal individual tests. So that is one. Second, yes, we have taken price increase in the month of Feb, which is also given an impact on annualized basis. It is about 2.5% kind of increase from price increase.
Morning. Wanted to also understand what the outlook is now when it comes to your growth rate. Has that taken a bit of a slowdown, largely on the back of the fact that we have seen the entry of newer players?
I think it was more noise during COVID or post-COVID, but honestly, last couple of quarters we have seen that competition is not that aggressive. Especially, when we talk about new age players or e-commerce players. So I have seen that last couple of quarters, this is now stabilizing and not much, aggression I have seen. Having said that, competition always there in this industry. If you see, we are the largest, we are the market leader. In spite of that, we don't have market share of more than 5-6%. So it's a very, very unorganized. We have seen competition earlier also, but this competition was very, very different as we have seen during COVID days. But right now, I think it is stabilizing and no more, it's like freebies or people were throwing hefty discount. I think there is price increase also taken by some of these players. So I believe now it is stabilizing here.
I'll look at the broad picture here. The broad picture here is that there is one disruption which is happening because of the online diagnostic tie-ups. Whether it is Pharmacy and Therocare, Tatas have moved into it, Reliance is giving that service. That makes it a platform service. If you have a prescription of a doctor, you get the diagnostics and you also get the medical advice and you also get the prescription medicine all in one platform. Is that going to be a disruptive challenge for a standalone diagnostic firms like Dr. Lal? Because what you are offering is one unique service, but what diagnostic online businesses are offering, they're giving a complete platform solution.
I think there is, debate whether it is one integrated service, which is, where people can avail all the services on one platform. And we have seen, in fact, the players who have started integrating service. It is called a platform or integration, integrated platform where you can go. And you are right that prescription is one. one can have consultancy, one can have medicine, one can have diagnostic from the same channel. But here it's not that always people, opt for this kind of, they have to make choices. And if your platform don't have choice, let's suppose if I want to do a test from one particular diagnostic, then they have my name also. And by the way, we also have tie-ups with these all integrated players, though we don't have much business from that. But people wants choice. Let's suppose you have given Thyrocare and PharmEasy, example. If I want to do test from Thyrocare, then I don't want to visit, PharmEasy site, because Thyrocare also have a independent website. So I don't think integrated service is where always preferred, because there is a choice which is more important. People have to choose which diagnostic, which player they have to test. It is convenient that one prescription, one platform, but it is not always the case where people just visit because they want that integrated service from one player.
And wait, just before I let you go, wanted to understand your wellness business, which is SwasthFits. Its revenue contribution has jumped up from 13 all the way to 22%. Where is it expected to head, let's say, in the next 12 to 24 months?
I don't think we have put in any numbers, but the way it is going, I think there is a potential where people opting more and more bundle packages. They find value for money in this, because we give discounts here, and they also don't need to visit again and again. And same time, it is beneficial for us because my servicing cost is very high, and if I service same patient, even if I give more tests to same patient, it makes sense for me. So I think I'm not putting any number, but directionally, I think more and more people are opting for this, and this is very good way of increasing realization and increasing profitability as well.
Okay, so can we assume that a 15% growth and a 25% margin is really a realistic number for FY24 for Dr. Path Lab?
So Nikunj, I'm not commenting on the numbers, but directionally I can tell you, I mean, we are at a level where pre-COVID days. So whatever I think I can tell you past, but not the future. But in the last year we did about 15% revenue growth, non-COVID revenue growth, which includes Suburban as well, because Suburban was not there last year. So it has the impact of Suburban also. But if we see last 4 years CAGR, it is about 10-11% CAGR for last 4 years on non-COVID basis.
Okay, we'll let you go on that note. Thank you so much for joining us today. But shifting focus to the big exclusive that we have for you right here on ET Now, and it's ITC interview. That stock has been a smart performer over the past 1 year, hovering near the life high levels. And the CMD Sanjeev Puri believes that they are firing on all cylinders. Focus will be on diversification and the next leg of growth. Listen into this riveting conversation between Nikunj Dalmia and Mr. Sanjeev Puri.
As part of the ITC next strategy is really to execute the structural drivers that are going to give us the next horizon of growth, profitability and competitiveness. And while doing so, we cognize for the fact that we are today living in a world where uncertainty is a true character. And it's like not over medium term, but it happens within a year. So organizations necessarily need to be very nimble, agile, and consumer-centric, because this poses challenges, and also any change is also an opportunity. So therefore, the starting point for us has been how we organize ourselves. So we've organized ourselves in terms of empowered teams focused on product market clusters. And then we have pressed the accelerator hard on certain tools that are important for competitiveness. So be it digital, and digital is now mainstreamed in our company. It is part of everybody's job, whether it is agri-sourcing or procurement or operations, manufacturing, consumer marketing, commerce, the works. Everywhere it is there. You know, since pre-COVID days, our, for example, in FMCG, our digital commerce is up 7x. Our investments in marketing through digital are up 4x. In our paperboard business, just by Industry 4.0, we have got 230 basis points improvement. The second is sustainability. And sustainability because of multiple reasons. One, it's of course a very rightly an expectation of stakeholders. Consumers are slowly, very clearly saying that they want to be associated with companies that are climate positive, companies that are bringing up sustainable solutions. So in hotels, for example, the world's first LEED certified net zero carbon hotels are all ITC hotels. It's also about the manner in which you're going to build resilience in your operation. And for us, we also see this as an opportunity to build new business models that can actually add to our competitiveness. The integrated fiber chain of PSPD is one, for example. The third piece is innovation. And it's not merely about making innovation more impactful and purposeful. I think what is important in this fast changing world, innovation has to be agile. It has to be fast. Right from inciting to markets, it has to be at a much faster speed. So that's where both digital and creation of platforms comes in place. And the fourth piece in every business is about not merely efficiency in supply chain, but also resilience and agility. How do you embed all these parameters together? So these are the pillars around which we have been working across all the businesses. And of course, it's a journey. I won't say everything is already done, but I think we have made appreciable progress. And there are multiple initiatives ongoing to take us to the next level from what we have come.
All right, that's a slice of the conversation with the top management at ITC. Moving right on then, let's put the spotlight on Capri Global, talk a little bit about the outlook when it comes to the key drivers, as well as the view on the strategy to grow the business. Rajesh Sharma is the MD and CEO now joining us on the show. Thank you so much for taking time out. Let's just begin by talking about your growth because your capital adequacy has remained quite strong. How are you looking at credit growth holding up for FY24?
If we talk about Capri, I think on the back of our strong expansion across all vertical MSME, home loan and gold loan, now we have almost more than 800 branches operational. And back of this, we are targeting a 30% growth across all AUMs. And last year, while we have grown 56%, this is the growth we are targeting this year minimum. And we think that key growth driver will be MSME and gold loans.
30% growth is what you're expecting in the AUM. That's about FY24. But what about, let's say, FY25 and onwards? Is this kind of run rate sustainable?
Yeah, because we continue to will expand our branch network. I think by September, we intend to cross 1,000 branch network. And then gradually, depending on our strategy and everything, we'll grow our MSME home loan as well. So I think achieving a 30% growth, when we look at the MSME segment, gold loan segment, home loan segment, there's a huge opportunity gap exists. And that is where we are quite confident that on the back of economic recovery, and if India has to reach 5 trillion economy, I think all these sectors are going to contribute their own contribution. And within that, we can have a space. So we are quite confident that 30% growth across all and for next 4 or 5 years should be possible.
Good morning, Rajesh ji. Nikunj also joining in. First, hearty congratulations on the great news on your daughter's engagement.
Thank you.
So how will life change for you now?
No, life remains the same. Only thing you feel little that yes, things have moved where we, as a parent, we expect daughter to get a suitable life partner and we move in that journey. So aligning with one more family, I think that gives joy.
Fantastic. Congratulations on that news again. You started incubating a big business last couple of quarters ago. That was the gold business. Initially, you were investing in that business and the benefits would come after 2 to 3 years. What is the size of that business and when will that business turn profitable?
So, when we started gold loan, we have evaluated that unless we have a branch network which has a reasonable size, we will not going to make a significant contribution. So gold loan branch normally take 12 to 15 months time to break even. And then after that, they start recovering their costs and they start delivering profit. So at the end of 24 months of each branch, we expect every branch to deliver the profit. So first 15 months, we have to invest in the capex, which involves strong room, entire setting of the branch and everything. And then you have to achieve a particular size of the AUM. Unless we reach AUM of about 3.5 crore per branch, we don't start making money. So already we have reached about 2.5 crore rupees per branch by now. And I think in next 6-8 months, we should be, all branches we started 12 months ago should start delivering profit. And we see really the bottom line contribution will start flowing in real sense from 24-25 onwards.
Soon you think you will be a 500 crore PAT company. You're in an expansion phase. Then the leverage benefits would kick in. 500 crore ka PAT, 3 saal, 4 saal.
No, 24-25 will be 500 because this year we will expecting a PAT of about 320 to 350. And next year, whatever this year, the estimated projected loss of the gold loan will be about 90 crore rupees. So that loss will go away. Plus our MSME home loan AU will also grow. So that will also start increasing their contribution. So overall 24-20 financial year 25 when we end in March 25, we will be around that figure.
Your ROA trend, which was at about 3.8% last year, was 2.1. I understand that interest rates were moving higher and NBFCs, since they borrow from the wholesale market, they will have a disadvantage. Now that interest rates are turning benign and they've stabilized, are we in for an ROA and a NIM expansion going forward?
So if we talk about this drop in ROA, it was because of the gold loan. We have invested about 160 crore rupees. If we adjust the gold loan losses, our ROA would have been about 3.5%. And NIM, if we talk about NIM, because we have recently infused our capital and net interest margin also reflect that contribution. I think NIM this year will be about 10%. If we talk about the spread, our spread will be continue to increase because of the gold loan is going to contribute the higher spread in the overall margins. So margins will improve significantly. Our gold loan portfolio was 1,100 crore. This year we close about 2,500 crore plus. Plus, we are also tying up with a few PSU bank for gold loan co-lending, and I think that will also help us to do the fee-based income. So overall, I think our margin will be much better this year, and going forward, it will a significant increase you can see.
Your business, Rajesh ji, potentially could get challenged by fintech.
So my observation and experience is that fintech are very cost-efficient originator, but still the collection piece in the segment we operate in, like MSME, home loan, and gold loan, collection piece will not be able to still solved by the fintech. So I think partnering with fintech for all lenders will be a way going forward where they will originate the loan. Now RBI has allowed the FLDG. So with tying up with the FLDG, you also curate and navigate their origination. You put your filters. I think this could be a very good collaborative mode. Fintech alone may not be able, every fintech alone may not be able to do well, but in partnership with some lender, I think it is a win-win situation for lender as well as the fintech.
Now that you're a proud owner of a cricket team, what is the next thing we should expect from you?
No, I think we are focusing how you increase your visibility and branding across rural and semi-urban. And that is the reason we have chosen to be having the Kho team, Kabaddi team, Women Premier League. I think these are the sports which are going to increase our branding visibility. It is also helping us in the gold loan when the customer wants to part with their security. I think gold loan is the only product where the customer part with their collateral and they put in our custody. They should have heard about us. Plus, they should be able to relate about us. So I think while sports will independently will be profitable in times to come, but till then it will have a collateral benefit to the overall enhancing our brand.
And Mr. Sharma, just before I let you go, you did talk about how MSME is going to be the sector which will lead the growth. But what about the asset quality issues there? The NPAs the last time we understand were between 3 to 4%. How's that expected to track? The recoveries?
So if you see after the COVID economy has recovered and we see across all segment, our collection efficiency has significantly improved. If you see the last year, the gross NPA was about 2.4, which has come down to 1.6%. And we see that NPA will not be challenged in MSME, even though NPA happens because they are all collateralized with some either self-occupied house or business premises. We are able to recover the entire money from them. So in our business, we don't see much credit losses. NPA may happen in the cycle turn bad like COVID, but we don't see these kind of challenges going forward. So we expect that our NPA will remain within the range of not crossing about 2.5% overall basis.
Overall NPAs to stay below 2.5%. Thank you, Mr. Sharma, for joining us today. Really appreciate your time. Taking a quick look at the markets, and it's not a very, it's not a very bad picture because Nifty is just around that flat line. We had dipped into the red, but from there we have made a bit of a, okay, so actually we're off the highest point of the trading session. I stand corrected. 18,667 is where the Nifty is at. In terms of stock-specific action, though, it continues to be ICICI Securities that's stealing the limelight right now, 14% higher. So let's go across to my colleague Ankur to try and understand what's the latest and what's this entire buzz around the delisting consideration.
In general terms, when a delisting happens, the expectation of shareholder is that they are going to get cash. But this time, if we see details of the delisting notification which has been received on exchanges, it says that Rule 37 of Securities and Exchange Board of India delisting norms, which clearly means that the approval which the bank has got is for swapping of shares. Meaning the shareholders will get shares of ICICI Bank, and the announcement of details will happen on 29th when the actual board meeting is happening, and how many shares of ICICI Bank will get the shareholders of ICICI Securities will get. But for now, one thing is clear, that shareholders are not getting the cash in lieu of the shares which they are holding right now.
Thanks, Ankur, for that. But on that note, sipping to a very short break. Don't go anywhere.